Good afternoon, ladies and gentlemen. My name is Luther, and we're back for another episode of Coaching for Profit. Sitting here with me is, of course, the man himself, Brandon Moore, the president and CEO of BKM Certified Public Accountants. All right, we're going to dive into this month's episode, which is selling a business. Brandon, go ahead and fill me in and our listeners. What is selling a business?
Well, a lot of business owners, Luther, they started out with nothing and they created this entity, this business that is fully functioning. It's earning them a profit. It's earning their employees good wages. And it becomes a baby. I want to kind of label this podcast as selling the baby, because that's really what it becomes, for a lot of business owners. Is it's selling something that they really, really love, and it's hard to even think about selling that baby. I mean, I wouldn't sell any of my kids for nothing. There's no amount of money that you could offer me. And so, unfortunately, a lot of business owners have that same mentality.
I had to struggle not laughing when you said selling a baby. I don't know about that one.
That's not what we're doing here, folks. We are not selling babies. We're talking about a business that you own and needing to part ways with that business.
So, selling the baby, or also known as the business, I guess the first step would be how to properly quantify how much this baby is worth.
That's right. I guess the baby analogy can only go so far, So how is a business valued is what you meant to say.
Sure.
Yeah. Well, businesses, depending on the type, have their valuation from various quantifiable methods. And if you go to a qualified business valuation expert, there's several CPAs that have certification in business valuation. There's a lot of appraisers that also get accreditation in business valuation. What they're looking for is, how's the business done over the last 3 to 5 years? And then will it go forward and produce the same value that it has currently? So they're going to look at your gross revenue versus your free cash flow. So if the business is earning, let's say $700,000 a year or $2 million a year, how much of that goes to the owner of the business? Is it 25%? Is it 30%? Is it 50%? That's one of what amount of the free cash flow from that business. That's gross revenues minus all the expenses, then before any of the perks that business owners get through their business, what amount goes directly to that owner. And then what some business valuators will do, will take that cash flow and put it into what's called the discounted cash flow method to come up with a valuation. In order to do that, they need to have some, and I don't want to get into the weeds and how it's calculated, but they'll use a cap rate, an expected growth rate, sometimes based on the trends from the previous years. And those growth trends matter. And we'll talk about that in just a few minutes. But the growth trends, that if you're growing, on an annual basis by 3%, that's good. A lot of people don't think that would be very good, but that is very good. A better growth rate, of course, is anything above 10%. And, that makes the value of the company go a lot higher rather than just a 3% growth rate. Also, how dependent is the business on key employees or the owner, him or herself? As a CPA, that's one of the biggest issues that, if I'm going to buy another client list or buy another book of business from another CPA or another accounting firm, how dependent is that accounting firm on the previous CPA or their staff? You don't necessarily want it to be to where every question has to go to the owner. You don't want it to necessarily be that if that person leaves, and I shouldn't have brought in the CPA business, but any business, if the key person leaves, will the business fall apart? How dependent is the operation? So you can see, if, let's say there's a retail shop has a lot of good products, you might think, well, that's not necessarily dependent upon the owner. That's dependent on the products they sell. Well, some cases the owner is the one who goes to market and chooses what products they're going to offer in that store. We have a client that the owner is a absolute genius in buying goods for her store. And if anything happened to her, or if they sold the business and she hadn't trained another person to do that, which sometimes that can't be trained. That's an eye for what's going to sell. That business may be really directly tied to that person or individual, whereas an online or a business that produces goods or sells goods online that are either mass produced or easy to come by, that may not necessarily be dependent on that person. That business would have a higher value on their cash flow than a business that has completely dependent. And the reason is, if once they sell, the previous owner is not going to be there anymore. And so some of that value that the previous owner brought to the table isn't there. And unless you replace it with somebody with equal or greater value, you're going to have to discount or reduce the value of that business.
So how does someone looking on the outside, looking in, properly assess the amount of work that the owner contributes to the business? Since you would discount it for more work, wouldn't discount it if they had less work or they were less hands-on. How does someone from the outside gauge that?
That's a good question. And that really has to be, is the business relational? Or, like I said before, is it depending on the person having an eye for it? If a person who already has a successful business in the same retail space wants to increase their revenue or increase their market share by buying that other person's business, then, yeah, they've already got experience, and so the discount for that person is less. But if somebody like me had to go in and buy a retail shop that, depends on me choosing what sells and what doesn't sell, that business isn't going to do well. That's why I wouldn't look at buying that business. And so the buyer at that point needs to really have an understanding of the business to really know how dependent the owner is or the key employee is to that business.
Okay, so the next question I have then is, when would be the right time for someone to sell?
That's a good question. And I've had that question recently by 2 or 3 people. And some businesses may do well for a long, long time and can be passed on to your heirs. And so selling may not be the right choice. I'm just going to put that out there. Selling business is not always the right choice. Sometimes real estate businesses or real estate investing, those aren't necessarily dependent on the owner and can possibly be passed to the heirs relatively simply and with some good estate planning. A part of the value of the business is the tangible assets, but also the real assets of the business, the real estate. And you want to get that valued by a real estate appraiser and not just as a part of the business. Those are usually valued separately. But let's look at a business in terms of life cycle. When you start up, you're really, the revenues and the value of the company is basically going to follow the business cycle. You have startup, you have strategic growth, then you plateau. And then there starts a decline. And decline usually happens for a business, one, when they lose vision, or they get confused about their mission and purpose, or they lose some key employees. But it can happen with a business owner when he starts to think about retirement and slows down. They don't have the hunger anymore. They don't have the fight and passion to push in that business anymore. And so they pull back and they start to see, that decline. What I encourage most business owners is to have a target retirement date, and 3 to 5 years from that is when you start to think about selling the business. You never stop driving and having passion or vision if you have retirement as a goal, then you should also have a revenue goal as of that date of retirement. I want the revenues of this company to be at $2 million by the time I retire. And you might be at 1.8, 1.5. And so you're driving through retirement. It's like when you're playing baseball, you don't just slap at the ball, you drive through it. And with planning for retirement as a business owner, you really want to drive through that retirement date with your plan, with your succession planning. So 3 to 5 years before your retirement target date, you start thinking about retirement. You start thinking about who might be able to purchase this, or how do I want to have somebody come in and be my successor, or do I have any kids that might be interested in buying this business or taking over for me? So 3 to 5 years before is when you start. You should be selling at the peak, because that's when you'll get the peak value. And then you absolutely don't want to start thinking about selling when you've lost the passion completely and you don't want to show up for work anymore. That's the worst time, because then you've probably lost 20 to 30% of its value.
So what do you think is more important between trying to sell at a peak versus selling when I lose the passion, or maybe I'm approaching that 3 to 5 year time frame that's before my set retirement age? What kind of is more important? Is it keeping the business running until I reach that date, or should I, if I see in the market that maybe I'm approaching the peak now, should I sell now? What do you think?
Well, that's another thing too, is that there are a lot of people that they purpose to create businesses, build them up into their what they think is a good peak, and then sell those to a Fortune 500 company or something like that and cash out, and then go do it again. There's a lot of business investors, business-minded people that do that. They can take any ordinary business, make it extraordinary, sell it for gain, and then do it again. And there's lots of people that have done that over and over and over again. What we're talking about here is the small business owner, and they're getting closer and closer to the retirement. And every business owner thinks about, okay, when am I going to retire? One of the, a lot of people say, I'm going to work until I'm dead. The truth is that happens a lot. Unfortunately, there's a lot of people that should have retired, and they, on their way to work have a heart attack, or on, while at their desk have a stroke or something. And if I'm going away, and I want to be going away watching a baseball game with my family, I want to be going away on a beach in Florida, with my family, where I'm, enjoying life, not because I just can't give up this job and this career, which I love what I do, and I want to keep pressing and continue on, but it is not the reason I get up in the morning. So the reason I get up in the morning is for my family, and this job and this career is the means to that end. And I just happen to love what I do too. So it makes it a lot easier, right?
Nice.
So yeah, when you're thinking about retiring, if you felt, and you look back, you can look at your financials and see if the last 3 years you've had a decline, and it's because you haven't pushed. Well, then you've got 3 to 5 years to really push and see that trend happen to go up before you actually sell. That's what I would do. Is I would say, okay, I'm not in this game. I don't want to be in this game anymore. So let's create a 3-year plan where I'm going to push and I'm going to drive to hit these revenue targets and do what I did when I was younger. And then before, in the next few months, I'm going to find somebody who's going to be my successor and work out a deal so that they can buy in or purchase in at a set time in the future. And I wouldn't do it immediately. I wouldn't do it within 6 months. But you can. I mean, it's definitely, it's not unheard of for that to happen. But the best business sales are happening when they're at their peaks.
Okay. And is the peak probably for that specific industry, or is it kind of when a lot of transactions are taking place? Would you identify as, I guess, the peak?
Well, I don't think that the business cycle, the life cycle of business happens for every business. That process is going to happen several times during a business life. the life cycle of business can start to decline, and then the business owner or the leadership team gets a new vision, new purpose, and so then it starts moving up, and then it gets into the next plateau. They reach that goal, and if they don't set a new goal, it'll start to decline again, and then once they get a new goal, and so it can do that several times over a lifetime. It's just what we're talking about here is when you come to the point where you as the business owner are going to retire, and if you don't have a succession plan already put in place, it's time to start thinking about it before the decline happens.
Got you. Okay, so being more proactive than reactive.
Right.
Got you. Okay. Touching back on a question I believe I had earlier on how to value the business, the growth that's kind of assessed in the value, is that projection only made in about 3 to 5 years, or is it made in perpetuity? Like, I know when we talked about the growth aspect, well, how far do we measure that growth in trying to ascertain the value of the business?
Usually most business valuations are done 3 to 5 year historical periods. They want to see that 3 years is barely enough to see a trend. So 5 years would be best. But generally when I don't have much experience in buying other people's businesses, but I've seen in the sales of my clients that most of those business buyers wanted to see the last 3 years. I would generally recommend 5 to see a trend and see what the trends were. And then if you see a significant growth or a significant drop, you want to ask questions as to what happened there. If we had significant growth because we hired 2 employees who are rock star salesmen, what is their long-term plan at this company? Are they going to, as soon as the business sells, are they going to leave? And you'll see a decline because those 2 salespeople aren't there anymore. And so, when you see the trends, you can ask the questions at the what changed here, what changed there.
For the next question I have is, what can you do to, I guess, increase the value now that we've kind of talked about, the how do we assess the value, and we also touched on the timing to sell. Well, what do you think can increase the value of this baby?
Right. What can we do to increase the value? Make it prettier. That really pretty babies sell, right? This is not one of those shows, Luther. This is about businesses. Okay.
Yes, sir.
So yeah. Well, the first thing that you could do is for a business owner is to make it less dependent on themselves. And that's really, if you've read the book, The E-Myth, Revisited, E being entrepreneur, it was written in the 70s. It was a book about the myth of entrepreneurship, and that if you go out on your own, you're going to have this huge success and you won't have any, you'll be your own boss, yada, yada. And it really wasn't. It really laid a good foundation as to the process that an entrepreneur goes through of realizing that this is harder than it looks. And I can choose to work in my business or I can choose to work on my business. And if you choose to work on your business, you're going to be better off. And one of those things in working on your business is making it less dependent on you, the individual, or making it less dependent on 1 or 2 individuals, key employees. The second thing that any business owner can do is remove the debt, because any debt in the company is going to reduce the value of the business. And so I know that when we calculate value for the business, we'll take the free cash flow, we'll take the gross revenues, and we'll come up with a value, and then we'll subtract the debt from that, because any debt that has to be assumed. If the debt isn't going to be assumed, if it's personal debt or debt on vehicles that the owner is going to retain, you don't have to subtract that value, the dollar amount of the debt. But if you're selling the business and you want the value to seem or to be better than it currently is, it's a debt-free business is valued higher than a debt-encumbered business, especially if the new owner has to assume part of that debt. The next thing you can do is, clean up your books. it seems that there are a lot of small businesses that have a lot of personal expenses running through their business. And for an accountant, it's easy for us to go through and remove those at the end of the year and reclass them for tax purposes. But if you're producing financial statements for somebody to see for the valuing the business, you want to make sure that you identify what those personal expenses are, or even what amounts are going directly to the owner. So the add backs would be the owner's salary, the payroll taxes on the owner's salary, the owner's contribution to 401k, the owner's part of the health insurance, the owner's part of the auto expenses that won't be there. And the next owner might use the free cash flow for their auto expenses, but the owners that's selling they're not going to have the same auto expenses. So those are the add backs that you can put back into the business to value it better. And then the last thing is improve your brand recognition. And that happens with good marketing or good logos and placement of being a member of the community, visible to the community. What does your brand say about you? Also, how do you do customer service? If you prioritize customer service in the 3 to 5 years before you look to sell, and you become known for that, then that's going to add to the value of your business, because that's adding to the value of your brand.
All right, ladies and gentlemen, well, that'll do it for part 1 of Selling the Business, also known as Selling the Baby. We'll be back in part 2 and discuss some other aspects in selling the business. So without further ado, Brandon, go ahead and sign us off.
But yeah, coaching for profit. That's what this podcast is about, because we believe that profit equals your potential minus all the barriers.